Welcome to It's Our Money with Ellen Brown, a look behind the curtain of global finance and monetary control with one of the foremost experts in the field. Author of the bestseller Web of Debt and the Public Bank Solution, Ellen Brown's groundbreaking work began the movement to create new American public banks. We'll look at issues surrounding the world of money and the systems and powers that control it, as well as the progress being made on the public banking frontier. The program is underwritten by Public Banking Associates, a national consultancy of experts advising government leaders pursuing creation of their own public banks at publicbankingassociates.com.
We've got a really steep learning curve that we've got to kind of jump up or sort of fly up really rapidly, and I mean within the next few days, right? So I think to do is apprise local leaders and state leaders immediately this very week of just how important this facility is for them right now so that they can begin to plan on this basis and then begin to liaise with their regional Fed banks immediately to start availing themselves of this facility.
That's Dr. Robert Hockett of Cornell University, our guest today on It's Our Money with Ellen Brown. I'm Walt McCree, Senior Advisor to the Public Banking Institute and Ellen's co-host. Our economic and social worlds have been inalterably changed by the universal and inescapable challenge of the coronavirus pandemic. Among the shocking economic changes that would have seemed unimaginable a short couple of months ago is a development from the Federal Reserve that indicates an historic new opening for access by states and cities to its funding mechanisms. The importance of this is probably not apparent to most observers, since the arcane and obscure view of the Federal Reserve leave most people in the dark about how they come up with the money that they throw into the world's economy. What some may know or remember is that the Fed bailed out the world's banks 10 years ago to the tune of $29 trillion without the permission of Congress. It did a similar deed last fall by covering the debts and paper imbalances of corporations in the repo market to the tune of $1.5 trillion, also without congressional approval. Its latest role in collaborating with the U.S. Treasury is to spin out several trillion more dollars to cover the impending collapse of our economic framework as businesses close and people go without jobs, or lose more ground in their personal, financial, and communal lives. It's a time when reflection on what's truly valuable slips into view in the absence of the usual daily distractions of life and work. Some are finding that the go-go economy may not have been worth so much of their time. Others are lost without their daily reference points. Most are concerned about what we will be left with when this pandemic dies down. Will our economy come back? What will not be there when it does? And how will we get to the other side of this when our own incomes and securities are diminished or have disappeared? Today, in an extended phone conversation with Bob Hockett, Ellen and I discuss his call for immediate action by state and municipal executives to get connected to the Fed through their newly established special purpose vehicles that have been opened for use by the nation's states and cities. This is a big deal because it is the states and cities that provide the sinews and fabric of our communities, our services, our safety and systems, all depending on their efficient and capable management. But states and cities face enormous challenges in this pandemic environment because they're losing massive amounts of revenue at a time of greater demand for money. The problems are complex. The demands are huge. The need for money grows. But the cities are not in a position to borrow from capital markets that they usually do because those capital markets are not available or interested in state and government bonds because of this economic collapse. The governments are dependent on outside support for money, and they'll be in that position for the foreseeable future. So join us for a look at what's going on around us all, and let's start now with a visit with Ellen.
So, Ellen, we've been through a lot of extraordinary times over the last couple of years, financial and monetary and economic times, and but nothing on the scale or of the ubiquitous nature of this one, which has the world captured in a colossal collapse of economies built around market interests and market operations. So it's been a time for a great reflection on not just about what's important and how things work, but what we might possibly be able to create. And this week we're talking with Dr. Robert Hockett, who's been within the IMF and the Federal Reserve, and who was talking about with some urgency about how the cities and states are suddenly able to access the Fed directly. That's going to be a very important topic for us to discuss today and all of its implications. What do you see about how debt is constraining people's sense of what could be possible to solve this problem and to get out of this predicament, moving forward from here?
So the Federal Reserve and Congress together have done a $6 trillion bailout, essentially, where the money is actually all coming from the Federal Reserve. There was an article in the New York Times today saying that basically they've now acknowledged MMT, modern monetary theory, that the government can go much farther into debt than have been allowed previously on the theory that the government has to balance its books. It really doesn't. That's austerity thinking, and that we can really print as much money as we can. Definitely print all the money we need for productive purposes, because the money will create things that will then pay the loans back. In other words, you can definitely do it in the form of loans that will be paid back, because that all gets balanced out. That's the theory of quantitative easing, that it can be reversed, that you can sell the bonds back into the economy, et cetera. But it's questionable whether the debt ever does get paid back. They tried to do quantitative tightening. They tried to sell the debt back, and the stock market collapsed and everybody freaked out. And so the Federal Reserve reversed their quantitative tightening and went back to quantitative easing. So as Max Kaiser says, you can't reverse a Ponzi scheme. In other words, you put the money out there, you can't pull it back. And we've seen that it hasn't triggered hyperinflation. You see all kinds of alarmists now on the internet, in podcasts and so forth, saying that the dollar is about to collapse and we're about to go into hyperinflation. But we're not. The dollar is actually strengthening. The dollar is stronger now relative to other currencies globally than it was a year ago, when we were supposedly in the good times were rolling before this unexpected crisis. So why is that? It's because everybody wants dollars. Even when people are having to pay off their debts, then they're pulling their dollars out of the bank, which means the banks have to have more dollars. And abroad, they're creating dollars that don't even exist. There's this whole shadow banking system that works abroad, where just like in the U.S., where banks create money on their books that is merely credit, so they're expanding their real money, their capital, by a factor of 10, or they can, and the shadow banks do the same thing, rehypothecation. They're doing that abroad as well, creating this phantom dollars. And then when you have a crisis and everybody rushes to cash in their dollars, or you've got these multiple rehypothecated loans where they're all based on basically the same dollars, and then suddenly all the creditors want their money back, and so there's a big scramble to get the dollars. So there's more demand, not less, for dollars. The hyperinflations that we've seen in history are all governments that owe debts in a currency not their own. And if you own debt, if your debts are owed in your own currency, you can obviously create the money as needed.
People are mostly concerned about where's their next money going to come from.
So we've got this $4 trillion that will be based on $454 billion put up by the Treasury, and out of that, the Federal Reserve will make another $4 trillion in credit. Most of that goes to corporations, and particularly big corporations. And it's not that they didn't really need the money. I mean, it actually isn't their fault that the money they had is no longer enough. The debts have been canceled, or their debts have gone up. It's the fault of the central government and the state governments imposing this shutdown. So we can't really complain like in 2008, like here are the crooks that got us into this and they're the ones getting bailed out, because in this instance they really aren't the perpetrators. But there's still the fact that virtually all of that money, except for the part going to state and local governments, which we will be talking about later with Bob Hockett, virtually all of that money is going to corporate America. It's not going to all the wage earners who just got laid off, and all they get is $1,200 once and then some unemployment benefit.
So we're in a new era of community experience about what debt is.
Yeah, well, the argument against giving the money to the people directly, that always has been the argument against helicopter money, which is where Milton Friedman said that you can easily cure a deflation, which is, deflation is depression, by just flying over the people and dropping money on them. So this is money that won't be paid back. That's the difference. Where quantitative easing supposedly was reversible, helicopter money is not reversible. And the argument is that would be inflationary, but it actually won't, because it's the nature of our money system to be chronically deflationary. It's always shrinking because debt always grows faster than the money available to repay it. And it's not just because of the interest that isn't created in the original loan. It's also because most money trickles up. It trickles into the financialized economy, and it doesn't come back into the real producer-consumer economies. And if you don't have consumers to buy stuff, your economy is going to collapse anyway. So you need to get money into the consumer's pockets just to buy the products that you're going to make with the other portion of the money that's going to go into productivity, into like productive loans.
Yeah, and the state and local governments are facing a crisis that we're going to be talking with Bob about. When people are unemployed, the revenues, tax revenues on which the states and cities depend, sales tax revenues, all of that is suddenly curtailed. Now the solution seems to be we've got to open the spigot of capital all over the place. Everybody gets it. A helicopter sort of a drop, as you're suggesting, but only if it gets to the people.
Another mask that's been ripped off our private system, which is supposedly sustainable, is that it's not sustainable. That our only source of credit, all of our money, first of all, is just credit created by banks on their books. The real source of all that money is the central bank, which is the full faith and credit of we the people. It's just credit. And therefore, we need a central bank that is actually working for the people. We the people are backing all this credit. We need to, you could say, nationalize it, although a lot of people don't like that term, but we need to have public representation there. It needs to actually be operating for the people. And I would argue you could put another $4 trillion into the system for the people, and you will only do good things for the economy. I've said this before, but the Chinese increased their money supply by 1,800% in 20 years, and their consumer price index remained stable through that whole period.
There's a lot for us to address at a time like this, and I think one of the most exciting and really urgent things that is on the table is being brought to us by Bob Hockett, Dr. Hockett, who did this article in Forbes saying cities and states need to open up this new channel of money from the Fed in order to keep our system afloat and to meet needs of the cities and states as their revenues shrink and their costs expand. So let's talk to Bob, and let's visit that conversation and take it from there.
Okay.
We're pleased to share with you today a phone conversation that Ellen and I had yesterday with Dr. Robert Hockett, a professor of monetary law and economics at Cornell University, a noted national economist, co-author of the Green New Deal, consultant to the New York Fed and the IMF, and actively engaged with the development of new models of state financial architecture. He's also a member of the Public Banking Institute's advisory board. Bob just published an article in Forbes calling for urgent action by government financial officers to avail themselves of a promising and brand new relationship just announced by the Federal Reserve for low-cost credit to states and cities. Historically, both of them have lacked direct access to the Fed's money supply, but they're now being introduced to the enormous advantages of such a relationship. The ink is barely dry on the enabling policy documents at the Fed, but Hockett is already calling for immediate action by state and municipal officials to get acquainted and get connected to the Fed to help shape the resulting policy dimensions. You'll hear his urgency as he carefully lays out the ways that this development can be a permanent game changer for state and local finance. We agree that this needs to be given a national push.
So, Walt, yes, I'm entirely with you on this. I mean, I think as a default position, I think this is definitely a case where we have a national problem that should require a national response, right? In fact, you can think of this a pandemic as, in a way, the kind of the example par excellence of a spillover effect or an externality or a collective action problem is distinguished from an individual action problem or a border or, a problem that doesn't respect boundaries or borders. I mean, it's kind of interesting, isn't it, that we often use the metaphor of contagion in connection with financial regulation and bank regulation, and especially in connection with rescuing banks and other financial institutions during a financial panic, right? We say, well, there's a contagion effect, and therefore we need a national response, and in particular a national bailout for all of these financial institutions because the problem is contagious. And now here we are, we have the actual literal example of contagion from which that metaphor derives, and yet ironically enough, we seem to have a federal government right now that is entirely devoid of capacity to deal, basically mental capacity, but also it seems organizational capacity to deal with this national pandemic, with this national problem. It is a case study in what Alexander Hamilton famously referred to as imbecile government in justifying the move from the Articles of the Confederation to the Constitution. And of course, in his day, back in the late 18th century, imbecile it wasn't just a sort of pejorative term for people who were kind of dopey or dumb or whatever. It really meant somebody who lacked human agency, right? Somebody who was not compos mentis, somebody whose mind was not composed, right? Compos mentis. Government that wasn't coherent and wasn't able to act in a kind of unified way. And that's effectively what we have right now, I think, because the president himself is not compos mentis. And what that means is we're forced to look for these kind of imperfect substitutes at the state and city level, and they are definitely imperfect. But if they're all we have, then I think we have to come up with ways of sort of simulating collective action or federal action, making use of these more individualized or sort of more state-by-state actors.
Yeah, one thing I think is interesting is that in this case, unlike in 2008, it's not actually the fault of the banks. It's not actually the fault of the hedge funds, et cetera. So people are all freaked out that we're pouring all this free credit into big financial institutions. But we, like you say, we really have to do that because there's a quadrillion-dollar derivative market out there that could collapse if you let the counterparties collapse, then the parties on the other side collapse because they probably bet both ways as well. So you kind of have to prop everybody up, good or bad or whatever, in order to maintain liquidity and prevent a huge depression, which is what we're obviously heading into. But what we need is to get some of that credit out there for the people. It's all going to big business, and so you had just written a couple of very interesting articles in Forbes about the Fed's new
municipal liquidity
bond facility, that would bail out would buy municipal bonds. So, do you want to go into what your thinking was on that?
Sure. So, as you know, Ellen, I'm with you that as a general matter, it would be far better to use the FRA Section 14 authority and just have the purchase of longer-term municipal instruments or even just direct lending or granting to municipalities as a kind of permanent fixture of our financial arrangements, our sort of public-private financial arrangements. But barring, since we don't have that, and since that's probably not going to happen in the really near future, the next best thing is the Section 13.3 authority, at least once an actual facility is established under it. And the fact that Chairman Powell and the board announced late last week, right before the holiday weekend, basically on Holy Thursday, that they were now going to open the Municipal Liquidity Facility, and MLF, for the first time under that authority, is truly game-changing in at least three ways, I think, right? Or at least it's very important in at least three ways. The first is that it is a literal financial lifeline to cities and states that are right now seeing their budgets completely blown out by the fact that all of their revenue sources are drying up under, sort of everybody's, sheltering in place and social distancing and the like. B, their costs, right, the abatement costs that they're facing in dealing with the pandemic are rising at the same time. They're spiking actually at the same time that those revenues are plummeting, right? Yet C, these authorities, the public authorities at the state level and the local level, are altogether unfamiliar with Fed facilities because, of course, they've never been the beneficiaries of them before. So ironically, they have unbelievable need of this facility right now, and it's an incredibly important thing that has now become available to them. But then at the very same time, the irony is that, of course, they're completely unfamiliar with it. And that means we've got a really steep learning curve that we've got to kind of jump up or sort of fly up really rapidly, and I mean within the next few days, right? So I think to do is apprise local leaders and state leaders immediately this very week of just how important this facility is for them right now so that they can begin essentially to plan on this basis and then begin to liaise with their regional Fed banks immediately to start availing themselves of this facility. Now, we can, of course, get into more details on the facility if you like, but I'm guessing that you'd like me to pause right there.
Well, I was going to say, I'd say there's a D in there, which is that the bond market, the municipal bond market is collapsing. Like, everybody's dumping their bonds. So if they try to issue more debt, there's nobody to buy it. So the Fed, as I understand it, they aren't directly buying bonds. They're buying these notes that would be in anticipation of bonds or in anticipation of tax revenues, et cetera. Can you explain how that works? Is that something you have to go through a bond dealer to write those things, or is it just a loan? You just go to the Fed and take out a loan. That would be ideal. What I'm wondering is what the interest rate's going to be, because if it's going to be the same 4% that they're paying now, in other words, if the Fed is just taking these bonds off their hands that they don't have a market for elsewhere, that's good, but it's not the amazing liquidity that we're looking for. But if they could go to the Fed with 0% or even 1% would be a great deal for the states, because it's a lot lower than they can borrow now. That would be super. So can you explain how all that works?
Yeah, so the deal at the moment is looking like it's likely to be even better than that, right? So the details are still emerging, but at the moment they're speaking in terms of 10 basis points, which is amazing, right? Right, we're talking about 0.1%, right? So if that is in fact what it turns out to be, then it is virtually fee-free borrowing, right? And that will be extremely important if indeed that turns out to be the entirety of the costs that the cities and states face. With respect to the paper itself, I think there are two things that bear noting. The first is that there are indeed certain features that the so-called eligible notes, that's the term of art used by the term sheet, there are certain features that the eligible notes have to have, and we'll get into that in just a second. But before doing that, I want to emphasize that because this is very much a work in progress, and because both bond experts and analysts on the one hand and public finance experts and analysts on the other hand have been urging the Fed to move very quickly to the purchase of 3- and 5-year paper from cities and states, my guess is that the current 24-month maturity date is not going to last very long. Now, getting back to that then, so the first thing to note is that, everybody was anticipating last month that if the Fed does something like this, they'd be talking in terms of 12-month paper. So the very fact that they articulated it as 24-month paper officially as of this past Thursday is itself a very helpful sign, right? So we're talking about 2-year instruments, which is much better than, 6-month instruments or even 1-year instruments. But then if you add to this the fact that, again, so many are calling for 3- to 5-year instruments, and the fact that the Fed is not doing anything to discourage those calls, and add to that, finally, the fact that Powell keeps emphasizing again and again and again all of the loopholes on the conditions that are in the term sheet, meaning that there's a lot of room for exception from any condition that pinches that states enjoy, and his emphasis that they will continue to be watching conditions in the bond markets and in the cities with a view to further liberalization or easing going forward. All of that together spells to me an overwhelming likelihood that if this pandemic persists and in consequence a need for longer-term paper presents itself, that will be forthcoming. Okay, so that's the sort of background condition I think that's really critical to keep in mind. Now, against that backdrop, here's effectively what the rules sort of are, or what the conditions such as they are amount to. So first, as noted just now, it's 24-month maturity paper. Second, it is paper essentially as you described. It's basically sort of, you might call it liquidity anticipation paper if we're looking for a sort of generic term, because it's partly tax anticipation notes, but it's also anticipation notes associated with other anticipated sources of revenue that are kind of likenable to taxation in the sense that it's sort of short term. So the idea is that what the Fed is essentially trying to do, I think this is probably just to sort of avoid making things look like they're really terrible, even though, of course, they are really terrible. It's trying to make it look like this is just a liquidity facility, right? Like this is just a tide-over thing to help the cities out and help the states out in the face of a relatively short-term problem. But as you'll recall, they said the same thing about an awful lot of the new facilities that were opened up in 2008, 2009, and thereafter. And of course, sort of more broadly speaking, back in that time, they constantly said, well, yeah, the balance sheet has grown by orders of magnitude, but it'll shrink back down. And similarly, they said, yeah, we're taking Fannie Mae into federal receivership on August 25th of 2008, but it won't be in receivership forever. Well, last I checked, and I suspect last you checked, that balance sheet is still pretty large, and that Fannie Mae is still under federal receivership. So I think it's often the case these days that when we're told that something is going to be kind of short-term and it's really about liquidity, oftentimes it's going to turn out to be longer term and it's really going to be about solvency. And I think that's because we're in kind of a new normal where our broader macroeconomy is concerned. The sort of short-playing version might be that modern capitalism, especially financialized capitalism, eats itself unless we quarantine it away from certain sort of especially culturally significant sectors of life, including middle-class housing, and now, of course, including municipal financing of pandemic responses.
Mm-hmm. You mentioned 0.1%. I mean, that's pretty exciting, but is that written somewhere? Does that also apply to all the other SPV loans, like the hedge fund loans or, the commercial paper, all that?
I'm just taking this directly out of the current MLF term sheet put out on Thursday last week. And again, the term sheet itself is more specific than what the Fed sort of announced an intention to do back in March, but it still is fairly bare bones, right? The entirety of it occupies, I think, no more than 2 or 3 pages, depending on your font size. The point is at the moment that the Fed is not looking to make money out of this, and the Fed is not thinking that there's some substantial moral hazard problem such that it's going to have to impose discipline, so to speak, at this juncture at least, on states and cities that avail themselves of this facility, right? The real point that it's trying to make right now, and this is of course, as you know, right out of the Fed's typical playbook in recent years over the last decade and a half or so, is what you do is you offer what is effectively a virtually unconditional guarantee or a virtually unconditional lending facility that you then kind of package as if it were a temporary liquidity facility that mimics ordinary market practices. So as I think basically to have people thinking about, that market discipline is in place, and also that has people thinking that this isn't quite as far from normal as as we might otherwise think it to be. And the Fed probably wants us to think along those lines in turn so as to avoid the self-fulfilling prophecy effect that happens if people sort of think that the Fed is treating this as some sort of massive emergency that's just completely, unprecedented or whatever. It's the classic Fed tightrope walk, right? I mean, on the one hand, it has to convey confidence that it's ready to do, quote unquote, whatever it takes, right? Channeling Draghi. And yet at the same time, it has to sort of channel a kind of general impression that things aren't that bad, basically because if people do think that things are that bad, they might end up panicking even more, right? So you kind of want to convey confidence at the same time as while also convey confidence that you're ready to act, while at the same time avoiding the conveyance of fear that you're going to have to act, or that you're going to have to act even more. That's the sort of classic, I think, central banker's tightrope walk, and this is just the latest iteration of it. It seems to me.
I want to go back to the pricing. I see the pricing and origination fee thing, but I thought they were different. Like the origination fee is 10 basis points, but isn't
right,
that
and that's
just to get the loan? And then the pricing says it will be based on an eligible issuer's rating at the time of purchase. So I would guess that means the percentage, right?
That's the wriggle room. See, yeah, you're right. That's the origination fee. It's significant that the origination fee is the only thing that is stipulated at this point. The other, right, the actual rate that has to be paid is generically characterized, and note the reference to current, market conditions. Right? So I read this as a signal that the Fed is just basically going to say, look, we're going to figure out what the rate should be on the basis of what the needs are at any given moment, right, at any given time. And I think it's fairly clear, isn't it, that, at present, conditions are not such as to recommend saying, oh, yeah, we'll lend it to you, but you got to pay us, 10% and your firstborn children, right? So I think that, the fact that they don't specify, and the fact that that basically they use classic weasel terminology when it comes to referencing the rate, and the only thing they specifically reference is that origination fee of 10 basis points, I think that speaks volumes.
I wonder do you know what the rate is for the other types, the other liquidity facilities, like all the other assets they're buying?
I haven't read all of the other term sheets because I've been totally focused on the municipal front. I think the next thing I'm going to take a look at, because this is also sort of within my general sort of range of interests, is the small business stuff. I'm really curious about what they're doing with SBA, what they're doing with small business financing, partly as a general matter. This is just, again, sort of at the core of my own, long-term sort of academic interests and policy interests, but also, of course, because, as you know, there's a lot of news coming out that private sector banking institutions are already misusing this facility or trying to use it as a kind of arm-twisting device to get out from under certain federal regulations or penalties that they've been under for the last number of years. So I'm probably going to turn to that next. But at the moment, I'm still sort of almost exclusively fixated on the municipal facility, essentially for the reason that I kind of opened up with, which is that it's massively important, and at the same time, ironically, the beneficiaries are massively unlikely to understand it yet, precisely because it's never been an option before, right? So they're quite reasonably untutored in this stuff. They've never had it before. It's never been available to them before. So it's really important, I think, that they gear up really quickly. And again, I mean, when I say quickly, I mean as like today or tomorrow. And so I'll probably be focused almost exclusively on this for the coming few days or weeks. But the next thing I'll likely turn to is the small business facility. I sort of regret it, but for better or worse, most of my finance regulatory expert colleagues are really fixated on all of the other stuff, especially, the big bank stuff. And I sort of get why they're fixated on that, because that's kind of what they know, what they've done in the past and so forth. But it's also a little bit troubling to me because it's kind of less important, it seems to me, in relative terms, than is the MLF first and the small business facility second.
Well, we were pushing, or we were going to send letters to the governors that it's time to get public banks set up in short order because they could take advantage of the 0% interest rates that are now being offered to banks. But if this facility is actually at zero, that's also a very attractive option for them.
It is, isn't it? And again, I would not be at all surprised were it to turn out to be zero or effectively negative. But again, we'll see. I think it's not without. There's a sort of, in my view, procedurally speaking, there's an additional significance to the fact that this is still kind of a work in progress, and that there's still more specifics to be worked out. And that is that, as I think I mentioned to you and Walt yesterday when we were conversing in a more informal way, that what this really means is that there's a significant opportunity here for the states and the cities to determine the shape that this thing ultimately takes. You know what I mean? The more, in other words, the more work in progress like it is, right, the more evolving it is, the more true it is to say that the states and the cities are going to be co-authors. Because what the Fed ultimately does when it comes to filling in various blanks that are still yet to be filled in, very much, a lot of that filling in is going to be influenced by what the states and cities are demanding and what they're urging and what they're informing the Fed of, because the Fed is not fully informed either of just, how awful, how difficult the problems are on the ground in certain areas, right? They obviously have a general sense of it, especially as those problems are manifest in the bond markets, which they watch quite carefully. But when it, there's a lot of more visceral detail, right? Like temporary morgues on the streets of New York, which are, pretty much the 21st century equivalent of those piled up pine boxes that you see in old newsreel footage from the 1918 pandemic. As more and more of that kind of visceral knowledge is brought to the attention of the Fed board and the regional Fed banks by the cities and states, I think the more likely the Fed becomes to sort of develop the facility further along lines that are all the more, eased for the states and the cities. So I think it's in a sense, it's a kind of existential point, right? It's, how the whole idea of the existentialist, I guess, is that, being precedes essence or whatever it is. So you basically, you kind of make of it what it's going to be precisely because it is currently very protean. And that means that there's a kind of existential responsibility that the states and cities face, a kind of imperative to make the most of this, because this is the time to do it. It's all molten right now. It's all like hot. It's like glowing red molten steel, right? And the states and the cities can sort of determine the mold that it gets poured into in significant measure. It's not that they can just have anything they want, but it is that they can have much of what they want, and they can certainly optimize the shape this thing takes, because I don't think that the Fed wants to do this in a vacuum, right? I don't think the Fed is that arrogant. I certainly don't think that Chairman Powell is that arrogant, and I don't think that any current Fed board member is that arrogant as to think that they can just sort of create this out of whole cloth without any input from the states or cities who are meant to be the beneficiaries. So I think the states and cities want to play an active role.
We're talking with Dr. Robert Hockett about how the new Fed lending mechanisms can impact the economics of recovery from the coronavirus pandemic that is severely affecting states and large cities.
It seems that we're on the border of a whole new orchestration of our finances, opening up between the cities and the Fed. But they haven't had any direct relationship with the Fed, really. So who is in place at the state level, and is there at the Fed level a department or some leader?
The way things are being framed at the moment, so the Fed has not been specific yet. There's an ambiguous term you might have noticed in the term sheet. There's a reference to regional Federal Reserve Bank. But what it doesn't make clear is whether one regional Federal Reserve Bank will be handling all of this, or whether what it means to say is that each of the regional Fed banks will be handling the program within their respective jurisdictions. I hope it's the latter, and the latter seems to me to make the most sense. And if that's the case, then it seems to me that the really obvious thing to do would be for every state's public finance officers and for every major city's public finance officers to begin liaising immediately with their regional Fed banks. And as you guys know, of course, that doesn't just mean the San Francisco Fed for Californians. It means the San Francisco Fed's offices outside of San Francisco, because as you guys know, the regional Fed banks have offices in other cities, typically within the states in which they operate too, right? So, Dallas Fed obviously has people over in Houston as well, and Houston is one of those cities that would be eligible because it has a population well over 1 million people. So both Dallas and Houston are going to be themselves independently qualifying for this kind of aid. And presumably, Houston officials would be able to meet with Dallas Fed officials even in Houston. They wouldn't have to travel over to Dallas to do it. Dallas officials would presumably meet with Dallas Fed officials in Dallas, and so on across the country. My guess is that kind of liaising effort is going to be the most efficient way to do this. And then those regional Fed officials can basically provide further guidance through their legal departments in particular when it comes to drawing up the papers and determining, basically figuring out the issuances. And the public finance officials, for their part, along with the legal departments of the states and cities in question, have lots of experience with drawing up papers for new issuances and the like. So if they just basically sit down together, even if it's in Zoom rooms, given social distancing, with the appropriate regional Fed bank personnel, they should be able to write this stuff out really, really quickly. Again, in theory, they could do this very week. I'm hopeful that could happen, at least in some cases. But as you just noted, Walt, and as we've been noting since the outset, as we've been talking together, I mean, this, in one respect, this is very, very new, right, to the city and state officials. They have no experience in dealing with the Fed in this particular way. Happily, however, they do have lots of experience in writing up bond issuances and other kinds of paper issuance in other circumstances. So all they have to do now is deploy those particular skills and experiences in the writing up of basically kind of custom designed financial instruments that they can work in conjunction and collaboration with their Fed counterparts in drawing up, just to sort of optimize in a seamless way the bringing into being of this program.
Then our other approach was to have them form their own state-owned banks. It occurs to me that we could arguably get that set up by executive order, like very quickly, and then you still have the snag of the FDIC and the Fed. Do you think they would be amenable to like quickly approving state-owned banks?
I think that they would. I think in particular if we sort of phase what we do, if we sort of think in terms of a phase structure, my guess would be that in what I'll call a phase 2, this could be done relatively expeditiously. So sort of here's what I mean. By phase 1, I mean, I really think that here's a case where we don't wait for any other institutions to be established. We immediately start liaising directly with the Fed. Basically, the public finance officials I mentioned a moment ago start sitting down immediately with the regional Fed officials in their jurisdictions to work out the initial issuances for this, what we can think of as a first round of community QE. So this week, let's say, or maybe the next 2 weeks, constitute round 1 of community QE. Now, assuming that the pandemic doesn't just sort of disappear by a quote-unquote miracle, to quote our famous orange president, assuming that doesn't just end, the pandemic doesn't just come to an end by May or whatever, there's going to be additional work that has to be done, and this could be done in a somewhat longer, more deliberative way, but still not overly long way. And I think that I could easily imagine at least some states and cities working together with appropriate federal officials and state officials, state banking commissioners if need be, or the OCC if need be, the FDIC for sure, and the Fed for sure, to sort of draw up plans for, Bank of North Dakota style banks in their states or in their vicinities, maybe over the course of May and part of June, right? I see no reason why you couldn't get that all sort of up and running, or at least fully specified and mapped out before the end of June, especially given that the Bank of North Dakota people are always happy, as you know better than most, are always happy to help people with sort of replicating their model, but in ways that are adapted to specific local or state conditions in other jurisdictions. So it would be very easy, it seems to me, to design an institution like this very quickly, or relatively quickly at least, and then get the approval for it so that then you could have an actual public financial institution in every state that wants to avail itself of this new Fed facility. And at that point, then these public banks could become the new interface with the Fed for future community QE rounds, because I'm convinced that there are going to be a lot more rounds. I really do think we're going to move to 3- and 5-year issuances before this is over. And I think in the long run, we might actually have a permanent relation between state public banks on the one hand and regional Fed banks, and therefore the Fed board on the other hand. I think this will be the new normal of our financial system before 2021.
Right.
I know that's
and
optimistic sounding, but I think it's true.
Yeah, cool. And there are things besides the liquidity facility that a public bank could tap into. I mean, it could be helpful in distributing benefits from the federal government, and of course, it can leverage the money once it's a bank. If it's a depository bank, so they could definitely work together. Yeah.
If you think about it, the MLF itself is a kind of banking structure, right? I mean,
exactly.
It's
That's
up.
what I was saying before. They're really shadow banks that are allowed to borrow directly from the Federal Reserve.
Yeah, and also they're initially capitalized by the federal government, right? Treasury parks $35 billion in the MLF SPV, and then the Fed is going to lend the rest. So, there's no reason. I mean, if the SPV itself is effectively a banking structure, I see no reason why you can't then further lever by having state banking structures that lever further, right? And again, as long as this is being done on a non-for-profit basis and it's not being done by private sector banking institutions, I don't see any reason to be worried about any sort of systemic risk that this is going to introduce. I think of it, in fact, as simply getting money where it's actually due rather than using it to speculate on secondary and tertiary markets, as tends to happen now with QE money.
Right, and you see all these complaints about, the Fed's hyperinflating the money supply and we're going to collapse the dollar. No way. This is what a central bank is for, is to put liquidity out there when the banks aren't doing it. What people are missing is that not only does is money created, but money is destroyed. Money is created and destroyed by banks, and right now it's being destroyed right and left as people aren't taking out new loans or aren't finding anyone to buy their new loans, et cetera. So the money supply is or definitely will shrink radically until we get the whole economy back online.
Couldn't agree more. I mean, it's sort of like you can almost think about money as in sort of populational terms, right? I mean, every country has a birth rate, every country has a death rate, and it grows when the birth rate exceeds the death rate. It shrinks in the other direction. Japan, of course, has had a higher death rate than birth rate in recent decades, and so it has a shrinking population. U.S. has a growing population, but much more slowly growing than some other countries. It's sort of similar with money, right? I mean, at present, the death rate of money exceeds the birth rate of money, you might say, because loans are being extinguished or going into default at a much more rapid clip than they're being extended at this juncture. And it's obvious why that would be, right? I mean, why would anybody be lending on a profit, at least on a for-profit basis, in the current environment?
We're talking with Dr. Robert Hockett about the new provisions that the Federal Reserve is making to provide direct financing to the nation's states and cities.
Well, it would seem that we're approaching a goal line then, because this has been our primary objective, is to get a distributed network of public banks tied into a Federal Reserve that meets the state and local needs and supports that system. And in the face of the colossal economic collapse, there will be need for that. So it would seem that we should really be acting, and you're saying this, of course, Bob, immediately, let's get on with having the conversation. We may as well just go ahead, hey, this is where it needs to head, and here are the phases, and lay that out, as you have so nicely done. So who needs to get in that conversation? Powell and the regional banks themselves elicit that kind of an agenda and pursue it?
They can. One really great way to do this, or one very easy way to do this, it seems to me, would be if the Fed board issued either a directive or a very strong recommendation to the presidents and boards of all of the regional Fed banks, either instructing or highly recommending that they reach out to state governors and to, let's say, the leaders, let's say that the sort of majority leaders and minority leaders on both in both chambers of every state legislature, but basically just reach out to them, arrange to meet with them immediately. I mean, this very week, and discuss the new facility with them, basically brief them on the new facility, brief them on all of the opportunities that this new facility raises, brief them on the how-tos, which are going to be pretty simple. Again, you basically just get your public finance officers to start drawing up the papers for a new issuance, but one that you're not going to float on the market, but instead are going to sell directly to the SPV, and just get that ball rolling, right? That's the way to do it. That's one of the reasons we have, right, a federated Federal Reserve in the first place, right? This is sort of there's an interesting opportunity here for the Fed as well that is only occurring to me right now. But, you guys, I don't think we've talked about this before, but I'm sure you guys have talked about this independently, and I've talked about this independently as well, is that, the original structure of the Federal Reserve going back to 1913, it made a certain sense in its time because, of course, the national economy was not yet fully integrated. So there were significant variances between distinct regional economies within our broader national economy. That's still true to a degree, but much less so. But in any event, what this meant back in the 19-teens was that the regional Fed banks had very important roles to play with respect to their regional economies, both in ensuring that banking was working there, that financing was getting to the industries that needed it, that the banking industries that existed in those regions were functioning well, and so forth. In more modern times, of course, as the national economy has become more internally integrated and the differences between regions have sort of lessened over time, the role of or need for the regional Fed banks has been a little bit less obvious than it might have been, say, a century ago. But here's a case where the regional Fed banks can actually show themselves to be very valuable things to have, and hence to show the federated structure of the Federal Reserve System itself still to be a very good thing. Because in a sense, what we're doing right now is we're kind of, at least temporarily during the Trump years, devolving into a kind of 1913 economy as the states and the municipalities are sort of thrown on their own devices again, because the unitary federal government has become something more like what we saw under the Articles of the Confederation up to 1787, before the current Constitution was ratified. And so insofar as there's a kind of a devolution of that sort going on, where states and cities are becoming the new de facto federal agencies, their specific economies then are becoming more salient than the national economy in a way that they weren't or haven't been since about 100 years ago. And that means that, ironically, the 100-year-old structure of the Federal Reserve as we right now have it can actually kind of come in handy. It can actually prove to be a sort of halfway valuable thing at the moment. And this would be a great way for the Fed to take advantage of that and to sort of show that it's there and it's here, up and running and ready to go whenever it's needed, would be precisely to take this initiative that I'm suggesting right now and not wait, but reach out spontaneously to governors and legislators. I think that we can, get a lot going really quickly in New York, for one thing, maybe in Kansas City, probably in Minnesota with Neil, and anybody else that you guys might recommend that we might reach out to. I would love to do some efforts or initiatives out of the Bank of North Dakota in this connection as well. But it's interesting, right? The only public bank folk I know really well now west of the Rockies are the Bank of North Dakota, but east of the Rockies, I think we have a pretty good coverage. I keep thinking, what they're doing right now in Washington, it's almost as if Pearl Harbor had just been bombed, and FDR had sort of said, held a press conference saying that he's really, I'm really great, and good luck Hawaii, good luck with that Pearl Harbor thing, it's sort of unbelievable. I mean, you guys have probably heard this before. I mean, I've noticed, like, in the last maybe 4 or 5 years, there are two sort of epithets I've heard more than I ever had heard in my life before that. One is, people will share on social media some recent news story and they'll say, "Not from the Onion." Basically, you might think this is satire, but now the satirists aren't even as funny as the reality, right? And then the other one, of course, is you can't make this stuff up, And it's kind of like you can't, right? I mean, you can't really outdo the reality with satire anymore because the reality just is its own satire.
But can we recover? That will be the quest. It seems that I think about Michael Hudson's historical reference about the need for jubilee for debt forgiveness. That would be another category where the Fed could act decisively to dramatically change some of the economic equation that are before us.
Yeah, we're going to have a whole new system when it's over, so hopefully for the best. That's why it's our opportunity.
That's what I'm thinking too, I mean, and this is one of the reasons I keep sort of thinking in terms of a kind of a phase structure for response is that there are some things that we can do immediately with tools that are at hand simply by creatively deploying them and creatively using them. And, in so doing, we can literally save thousands of lives, since literally hundreds, if not thousands, of people are dying each day. But that's just for the immediate term, right? But there's also a kind of immediate term or a medium term, and I think of that as maybe the term that begins sometime in May and lasts maybe through the summer into the early autumn, perhaps, where we can start making some more permanent changes that effectively mean we don't have to improvise as much as we've been improvising lately. And then we can think beyond that in terms of even longer term structures where we ask ourselves, look, are there ways that we can change or reconfigure the way we do things so as to prevent anything like this happening ever again? Now, obviously, there are ways we can prevent a pandemic like this from happening again. One way to do it might be say, how about we get rid of these wet markets where, people buy bats and things to eat, right? But even apart from that, if we think in terms of the response, right, why didn't we have huge stockpiles of respiratory ventilators and masks and the like? Why didn't we have, extra hospital bed space ready to open up or expand right away? Why didn't we have a structure through which we could immediately ramp up production of certain essentials by temporarily commandeering, but also compensating for the commandeering private sector manufacturing institutions so that we could start cranking the stuff out really rapidly? Those are things that, we should, there's no reason that you should have to sort of think of that stuff or imagine that stuff only after a pandemic breaks out. We've been here before, right? And especially if you consider that there are other emergencies beyond pandemics that often require quick ramp-ups of certain kinds of production too, like, for example, bombings of Pearl Harbor, right, or entry into a First World War, or, other examples, right? And then, closer to the three of our hearts and, closer to our own specific policy agenda, public banking advocates, is there's a medium to longer term opportunity here to revamp our entire financial system, partly by putting in place a whole additional infrastructure of institutions that don't rely on private sector, profit-driven, Wall Street primary dealer banks to sort of get credit where it's due, get money where it's due, finance actual productive activity rather than just market betting activity. There's so much that I think we're going to be able to do now, and it won't be just opportunism on our part. It'll be basically capitalizing on the fact that public attention is now heightened and drawn to dysfunctions that ordinarily people ignore because you can kind of ignore them until they erupt, sort of like almost like a kind of chronic illness that periodically flares up, somebody with arthritis that is normally in remission but occasionally flares up, probably for lengthy periods of time can, kind of forget that he or she has the arthritis, and it's during the flare-up that they are reminded, and then they might think, well, maybe I should be on a different medication, or I should take more glucosamine on a regular basis, or whatever. And it seems to me we can kind of think along those lines here too, right? Where, the underlying condition has been there all along. Now that we're having a flare-up, this might be a good time while we're attending to it to see if we can't, change our treatment program in the long run so that the chronic illness itself is either lessened or indeed even eradicated, dare I say it.
Well, Bob, in the middle of a pandemic and grief, you brought up some bright spots.
Yeah, something to be happy or optimistic about, right?
Right.
Terrific. Yeah.
All right.
Okay, guys. Thank you. Thank you so much.
Great.
Thanks a million.
Thanks for your insight.
You too, guys.
Our thanks to Bob Hockett for his important and timely sharing of these new developments. The Public Banking Institute will be working nationally on connecting state and local leaders to this promising new prospect for recovery finance for the nation's states and cities. Well, that's it for this edition of It's Our Money with Ellen Brown. Our thanks to our guests, our sponsor, Public Banking Associates, and to you for listening. Be sure to check out Ellen's latest writings on the economy and the changing world of money by visiting ellenbrown.com. And for more information on public banking, visit publicbankinginstitute.org. For information on how local and state government leaders can obtain professional insight and counsel about public banks from key national experts, visit publicbankingassociates.com. I'm Walt McCree. See you next time on It's Our Money with Ellen Brown.